operating within the SEMA zone have faced political and economic headwinds. I'm Yvette Essen for AM Best TV, and I'm here to establish how companies have managed to grow profitably in recent years despite these challenges. Charlotte Vigier, Senior Financial Analyst for AM Best, is here to talk about those challenges and the market conditions. Can you explain to me, first of all, what is the SEMA zone?
The SEMA zone, or SEMA, is an insurance regulatory body which has the oversight for 14 francophone African countries. So the largest one in that market in terms of premium volume would be the Ivory Coast, Cameroon and Senegal. So all 14 members of the SEMA have agreed to transfer their regulatory and legislative power over to the SEMA, and the whole region is regulated by the SEMA code, which applies both to insurance and reinsurance companies in the market. So as of 2016, we had about 185 companies within the SEMA zone, most of which are non-life players, which is quite typical what you would see in those kind of African markets.
You mentioned 14 different countries there, so of course there are going to be lots of differences there. But what are the common threads, what are the common trends that we've seen across the region?
So all of those countries, it would be fair to say, that are still quite underdeveloped when it comes to insurance. The insurance penetration rate is about 1% compared to what would be around 6% on a worldwide basis. The market itself is small. It's about 3% of the overall African insurance market, which is represented by the SEMA. In addition to it being relatively young, it's also very much a profitable market across all the countries, and the profitability of the market has been supported by good technical results, both on the life and non-life side. Loss ratios over the last 3 years have typically been in the range of 40% for the different country members. And there's also good investment returns that have been supporting the performance of the market overall. However, one of the issues for all of those countries is that the environment is challenging. We classify the SEMA countries as a country risk tier 5, which is the highest one according to our methodology. So that means there is the highest level of political, economical and financial system risk over there. So in concrete terms, that means that there is a risk of political or social unrest, which could be disruptive for the market, both in terms of company being able to operate, but also it can generate claims if there are riots, for example. Another concrete consequence of that is often that the quality and the diversification of assets can be limited with a high dependency on a limited number of banks, for example.
The report also talks about regulation. Can you explain what some of the regulatory changes have been in the region?
Sure. So one of the features of the market is that the cession to reinsurance has been high over the years, and that's stemming to a large extent that local players, primary insurers, often lack the technical capacity and also the capital capacity to retain the risk. Some of the large risk would be too big for companies to retain. Likewise, the domestic reinsurance market, not being as developed as some other markets, struggles to retain those risks on its own balance sheet. So a lot of those reinsurance goes on to the international markets, and recently there have been reflection within the SEMA that it would be of benefit for the market if those risks were more retained. So there have been a couple of larger reforms recently, which are aimed both at increasing the amount of capital local players have to hold and also limiting how much can be ceded outside of the market.
But what do these regulations mean, though, for the companies in terms of implications going forward?
So on the one hand, because of those regulatory changes, insurance and reinsurance company will have to sometimes quite significantly increase the amount of capital and surplus that they hold. So that will bolster their balance sheet strengths going forward, which we see as a positive thing. The other part of the reforms are aimed at increasing the amount of reinsurance which is retained in the country, which means that for some reinsurers the amount of premium that they write will double. So concretely that means that reinsurance companies, in order to be able to manage that increased amount of business, will have to improve on their technical capabilities, and they will also need to do that in order to remunerate the additional capital that the shareholders would have put there. So we actually believe that whilst in the short term a lot of that additional reinsurance will be retroceded, so still make its way to the international reinsurance markets, in the longer term we see that as an opportunity for the market to increase its technical expertise, and which will also have a positive impact in the ERM approach of local players, which is currently one of the areas where we see some weaknesses in the market.
A copy of AM Best report on the CIMA zone can be found on ambest.com. For AM Best TV, I'm Yvette Essen.